Are you looking to invest wisely and avoid common pitfalls? If so, you're in the right place. Today, we're diving into one of the most influential books in the world of investing, The Intelligent Investor by Benjamin Graham. First published in 1949, this timeless classic has guided countless investors, including the legendary Warren Buffett, who described it as by far the best book on investing ever written. But what makes this book so special? And how can its teachings help you become a smarter, more successful investor? In this video, we'll break down the key concepts from The Intelligent Investor, including the fundamentals of value investing, the insightful Mr. Market allegory, the crucial principle of margin of safety, and much more. Whether you're a beginner or a seasoned investor, there's something valuable here for everyone. So watch until the end to get the full picture and transform your investment strategy. Before we dive in, don't forget to hit the like button, subscribe to our channel, and click the bell icon so you never miss an update. All right, let's get started on your journey to becoming an intelligent investor. Before we dive into the key concepts of The Intelligent Investor, let's take a moment to learn about the man behind the book, Benjamin Graham. Benjamin Graham, born in 1894, is often hailed as the father of value investing. His work in the early 20th century laid the groundwork for many of the investment principles still used today. Graham's career was marked by his deep understanding of market psychology and his disciplined approach to investing. Graduating from Columbia University, Graham started his career on Wall Street and quickly made a name for himself with his keen insights and analytical prowess. He later became a professor at Columbia Business School, influencing a generation of investors, including his most famous student, Warren Buffett. Warren Buffett once said, "Ben Graham taught me 45 years ago that in investing it isn't necessary to do extraordinary things to get extraordinary results." This testament to Graham's teaching underscores his lasting impact on the investment world. In 1949, Graham published The Intelligent Investor, a book that distills his investment philosophy into practical advice for novice and experienced investors. The book has since become a classic, guiding countless individuals towards smarter and safer investment decisions. Now that we know a bit about Benjamin Graham, let's explore the timeless principles he shared in The Intelligent Investor. Number 1. Value investing. Value investing is the strategy of selecting stocks that trade for less than their intrinsic value, a concept introduced and popularized by Benjamin Graham. This strategy involves identifying companies with strong fundamentals whose stocks are undervalued by the market. The idea is that the market overreacts to good and bad news, causing stock price movements that do not correspond to the company's long-term fundamentals. By purchasing stocks at prices lower than their intrinsic value, value investors aim to gain significant returns when the market eventually corrects itself. This requires a thorough analysis of a company's financial statements, understanding its business model, and assessing its long-term prospects. Value investing emphasizes a disciplined, patient approach, focusing on long-term gains rather than short-term market fluctuations. Imagine a company whose stock is priced at $50 per share, but after thorough analysis, you determine the intrinsic value to be $100 per share. By purchasing the stock at the undervalued price, you position yourself to profit when the market corrects itself. Number 2. Mr. Market. In The Intelligent Investor, Graham uses the allegory of Mr. Market to personify the stock market's volatility and emotional swings. Mr. Market is a hypothetical investor who comes to your door every day offering to buy or sell shares at different prices. Sometimes he is euphoric and offers to buy your shares at high prices. Other times he is despondent and offers to sell shares at very low prices. The key lesson is that Mr. Market's offers are often irrational and influenced by emotions rather than fundamental values. Investors should take advantage of Mr. Market's irrationality by buying when prices are low and selling when they are high, instead of letting Mr. Market's emotional state influence their own decisions. This concept teaches investors to remain objective and make decisions based on their analysis rather than market sentiments. On a given day, Mr. Market might offer to sell you a stock at $30 per share when he's feeling pessimistic, even though the stock is worth $50. Understanding that Mr. Market's moods are irrational allows investors to make informed decisions and avoid emotional reactions to market fluctuations. Number 3. Margin of safety. The margin of safety principle is one of the cornerstones of value investing as described by Graham. It involves investing in securities at a significant discount to their intrinsic value, thus providing a buffer against errors in analysis, unforeseen events, or market downturns. This safety net helps protect investors from substantial losses and reduces the risk associated with investing. The margin of safety concept is based on the understanding that all investments carry some level of risk, and that by purchasing assets at prices well below their calculated intrinsic value, investors can absorb potential errors in their valuation and unexpected adverse developments. This principle promotes cautious, disciplined investing and encourages investors to seek investments where the downside risk is minimized. If a stock's intrinsic value is estimated to be $100, purchasing it at $70 provides a margin of safety. This cushion helps protect against potential declines in value or mistakes in the valuation process. Number 4. Defensive versus enterprising investors. Graham categorizes investors into two types: defensive, passive investors, and enterprising, active investors. Defensive investors prioritize safety and the preservation of capital. They prefer a simple, low-risk approach to investing, often opting for a diversified portfolio of blue-chip stocks and bonds. Their goal is to achieve satisfactory returns with minimal effort and risk. Enterprising investors, on the other hand, are willing to put in significant time and effort to achieve higher returns. They actively seek out undervalued stocks, special situations, and market opportunities. This approach requires extensive research, analysis, and a deeper understanding of the market. Enterprising investors are more likely to engage in stock picking, market timing, and other active management strategies. Graham advises that investors should choose the approach that best suits their temperament, risk tolerance, and level of expertise. A defensive investor might choose a diversified portfolio of blue-chip stocks and bonds, while an enterprising investor might research and invest in undervalued small-cap stocks. Number 5. Stock analysis. Graham provides a detailed methodology for analyzing stocks, emphasizing the importance of understanding a company's financial health and long-term prospects. Key factors to consider include the company's earnings stability, financial strength, dividend record, and growth potential. Earnings stability involves analyzing a company's historical earnings to determine its ability to generate consistent profits. Financial strength is assessed by examining balance sheet metrics such as the debt-to-equity ratio to ensure the company is not over-leveraged. A strong dividend record indicates that the company consistently returns profits to shareholders, suggesting financial stability. Growth potential involves evaluating the company's future prospects and its ability to increase earnings over time. Graham's approach to stock analysis is methodical and disciplined, focusing on fundamental indicators rather than market trends or speculative factors. This helps investors make informed decisions based on objective data. To analyze a stock, you might examine its price-to-earnings, PE ratio, debt-to-equity ratio, historical earnings growth, and consistency in paying dividends. A strong company typically shows stable or growing earnings and a manageable level of debt. Number 6. Investment versus speculation. Graham emphasizes the crucial distinction between investment and speculation. Investment is defined as an operation that, upon thorough analysis, promises the safety of the principal and an adequate return. Investments are made based on a comprehensive understanding of the underlying asset's value and the likelihood of achieving a satisfactory return. Speculation, in contrast, involves taking on higher risk in hopes of achieving higher returns, often based on market trends or predictions rather than intrinsic value. Speculative activities are more akin to gambling and can lead to significant losses if the market moves unfavorably. Graham warns that speculation can be dangerous for investors who do not fully understand the risks involved. He advocates for a disciplined approach to investing, where decisions are made based on careful analysis and a clear understanding of the asset's value and potential. Investing in a well-established company with solid fundamentals after careful analysis is an investment. Buying stocks based on market trends or tips without substantial research is speculation. By understanding and applying these key concepts, investors can make more informed decisions, minimize risks, and achieve better long-term returns. Graham's emphasis on value, careful analysis, and emotional discipline remains relevant and valuable for modern investors. If you found these insights valuable, I highly recommend reading The Intelligent Investor by Benjamin Graham. For a deeper understanding, I'll leave a link to the book in the description below. We've covered a lot of ground today, exploring the essential principles of value investing, the wisdom of Mr. Market, the importance of maintaining a margin of safety, and the key differences between defensive and enterprising investors. Remember, the core of Graham's philosophy is about making informed, rational decisions and protecting your investments from market volatility. As you apply these timeless strategies to your own investment journey, keep in mind the importance of patience, discipline, and thorough analysis. Investing isn't about getting rich quickly. It's about building wealth steadily and securely over time. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more insightful content, and hit the notification bell so you never miss an update. We'd love to hear your thoughts and biggest takeaways from The Intelligent Investor in the comments below. And if you have any questions or topics you'd like us to cover in future videos, feel free to share them as well. Happy investing and see you in the next video.